The Credit Economy Part 2. Robots take the jobs, loans still remain. Flint West reporting. The credit economy rests on a single, now endangered assumption. Tomorrow's human labor and tomorrow's human income will reliably service the debt created today. That was the deal. That was the engine. That was the invisible contract. But now, artificial intelligence, robots, synthetic labor are stepping into the workforce. And not just stepping in, they're replacing it. At the same time, the baby boomers, the largest generation, are clocking out, retiring, drawing from the system. And the generations behind them, smaller, outnumbered, competing not just with each other, but with machines. So now the question becomes, if the system runs on future human income and humans are no longer the primary earners, then what exactly is backing the loan? Because make no mistake, the house is still collateral, the loan is still the product. But the future income, the thing that makes the whole structure hold, is disappearing. Section 1. Grounding in the mechanics. Let's slow this down. Let's bring it back to first principles. Banks do not lend savings, they create money. They issue long-duration loans, 15, 20, 30 years, backed by one thing, your future earnings. You get the house, you get the car, you get the degree. They get the stream, the payments, the duration. The asset? Secondary. The real transaction is this: future labor converted into present purchasing power. That's the system. That's the trick. That's the engine. And it worked because human labor was abundant, growing, expanding. More workers, more income, more loans, more asset inflation, more growth. And when the price of credit dropped, the future got pulled forward faster. When it rose, everything repriced overnight. We saw it. Same house, different rate, completely different reality. Section 2. The catalysts now undermining the system. Now the ground is shifting, and it's shifting from two directions at once. First, automation. Artificial intelligence and robots are no longer tools. They are substitutes. They do the work, they produce the output, they generate the value. But they do not take out mortgages. They do not qualify for loans. They do not sign 30-year contracts. And banks? Banks underwrite based on income. Documented income. Predictable income. No income, no loan. You can have perfect credit, perfect history, perfect behavior. But if the income disappears, so does your access to credit. Second, demographics. The baby boomers are exiting, en masse. And the generations behind them, they're smaller, they're stretched. They're funding pensions, funding healthcare, funding the past, while competing with machines for the future. So now the rollover breaks, because the system depends on this: new credit to support old credit. But fewer humans means less income, which means less credit creation, which means the engine starts to stall. And no, universal basic income doesn't fix it, not yet, because the system doesn't recognize it. It's seen as unstable, political, non-earned. So from a bank's perspective, it's not real income, which means it doesn't qualify. This content is brought to you by Bobby Gigs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 3. Real-world stakes. Now this is where it gets real. Credit slows, not just because rates are high, but because borrowers disappear. Asset prices come under pressure, not because houses changed, but because the ability to finance them did. Younger generations, they inherit the burden without the access. More debt to support, less ability to take on new debt. And the system itself becomes fragile because it was built on labor that no longer exists in the same way. If half the population ends up in technical unemployment or full leisure while machines do the work, then the question is no longer theoretical. It's structural. Who qualifies? Who borrows? Who pays? Because the rolling over of trillions doesn't happen automatically. It needs fuel. And that fuel was human income. Section 4. Contextual clarity and adaptation paths. Now here's the thing. The system doesn't just disappear. It adapts, it mutates, because it has to. So what happens next? Credit starts to anchor to ownership, not labor. If you own the machines, if you own the systems, if you own the output, then you have income, and income can be pledged. New forms of collateral emerge. Robot ownership, artificial intelligence output, data, intellectual property. The definition of income expands. Governments step in, they stabilize, they redefine. Maybe universal income becomes recognized. Maybe artificial intelligence dividends become standard. Central banks, they may go direct, bypass the system, fund activity themselves. Debt, it may get reset, restructured, extended, forgiven. Because history shows one thing: when repayment breaks, the system rewrites the rules. And then comes redistribution, because automation creates wealth, massive wealth. The question is, who owns it? Because ownership determines access, and access determines participation. Section 5. Final frame. The original model was simple. Human labor was abundant, so credit expanded. But now, labor is shrinking, machines are rising, and the link between credit and future value is breaking. The house will remain collateral, the loan will remain the product, but the foundation, the thing underneath it all, that has to change. Because the real question now is this: not what is being sold, not what is being bought, but who or what is actually paying. That answer determines everything. Flint West signing off.